Hey, gang, this is Mike with MrNoFluff.com, and Deutsche Bank is in trouble once again. And soon, you and I will be bailing them out with our hard earned money, just like we did in the last crash with different corporations. So, once again, Deutsche Bank in Germany, one of the largest banks out there, is in trouble. And soon you and I will be bailing them out through our paychecks, just like the last crash with different corporations. Okay, guys? And I'll tell you how that's going to happen in a few minutes. Um, but let me give you some updates about Deutsche Bank. Um, they're laying off 7,000 employees, okay? 7,000 guys. For the last 3 years, they haven't made a profit, ladies and gentlemen. Okay, um, and if you look at their stocks in the past, just if you just Google Deutsche Bank into Google's and then type in stocks, you'll see. Just go in there and look at the last 5 months. I mean, 5 years, the last month, and max, and you can see it's just going like this. Okay. Now, why is that important for you and me? Why do we care about some bank in Germany? Okay. Why do we care? We're not even Germans. The reason is that we're all interconnected through central banking system and fractional reserve lending and the, the, the monetary system, which is fiat, where we just print out. Okay. And so what that has to do is that all these countries are interwoven. Okay. Now, one example is like right now in Europe, Spain, Ireland, Greece, Portugal. I'm not sure if I pronounced it right. They're all having outstanding debt from their governments, and no other investors are willing to lend to them, and their bonds interest rates are just climbing up because no one wants to lend to them because they're defaulting. Okay, so those are just countries. Now, that's a different story than Deutsche Bank, which is in Germany, which is a very one of the largest lenders out there, and they're about to go belly up. Okay, now the reason that's going to affect you and I is because if they do go belly up, two things will happen. One, it's going to have a domino effect through all the other institutions, from insurance companies to other bankers, and to our everyday people, because when banks start losing money, they're going to call their notes, they're going to call their loans in, their mortgages, the car, and they want their money, and which makes the average people default. But that's not a story that I want to talk into, because once Deutsche Bank defaults, if the IMF, which is the International Monetary Fund, if they bail out um, Deutsche Bank, 40% of the money that comes in from the IMF, which is the international world, 40% is from the United States. Okay, so that means that me and you as workers, we're going to end up bailing out the IMF 40% of it, and the other countries will contribute, and then their IMF is going to give them the money, and then they're going to get Tuesday. They're going to lend the money out to Deutsche Bank. If they do that, okay, and in return, Deutsche Bank is going to pay the IMF with interest, which me and you're not going to get a penny of it, okay? But we're going to be the ones that bail them out, okay? And that's not even the most important thing. The most important thing, which is point number two, is by one falling, this thing can go across the world from, Japan, which is in trouble, to America, which is in trouble because we have so much debt, and we're not producing as much. That's why, like, if you look at my shirt, or if you look at your shirt or your shoes or your backpack or anything, your phone, this gadget, if you flip it over, it says made in some other country. Okay, that's just the way it is. Even your car, majority of people have Hondas or Toyotas. Okay, so what does that mean? We're not producing, right? What we're really good at producing is uh, debt, and clever devices to put the debt in, like, at Wall Street, where they did, mortgage-backed securities in the last crash, 2006 fourth quarter, why they would, lend out to subprime and package it up with good ones and a lot of bad ones, and then package it up and sell it on Wall Street to anyone that wanted to buy it. Okay, in any country. So we're good at that, producing debt. And here's the thing, with debt, as you can see, countries are defaulting. Okay, again, I just said Spain, guys, is not. I mean, it's a whole country. Okay, Greece is a whole country. Okay, Ireland, whole country. Uh, Portuguese or Portugal. I'm sorry, I'm freestyling this. So as you can see, even in America, like the average American person is in debt. Okay, the average uh, business in America is in debt. For example, let's say talk about Toys R Us, or let's talk about Blockbuster, talk about GMC or Ford. That's why we had to bail them out, because we're growing and growing and growing, but we're all grown through fake money, debt, the central bankers' money. Okay, and it's not solid growth. It's kind of like injecting yourself with steroids. Okay, you can get real big, but it's not like you build it through many years of hard work and calluses. And so, if Deutsche Bank collapses, it's going to do two things. A, the International Monetary Fund bails them out. Means 40% of that is from U.S. people, workers. So we're going to have to put 40% of what, if they're billion on trillions of dollars or millions of dollars, we're going to have to put 40, and the other nations in the world put the remaining 60. Okay, but 40% is still a lot. Okay. Number two is that it's going to be the domino effect, just like 2006 fourth quarter. There was a small couple of bankers that defaulted, and then the big giants like Lehman Brother defaulted, because people insure stuff. There's like stocks, there's derivatives, there's all kinds of stuff, right? And so when one thing defaults, the other one defaults, there becomes a panic in the market. People start pulling their money out, which more things default, and so on and so on. And bankers call the notes in, like, hey, I want my money, and things of that nature, which cause more defaults. So simply put, I brought to you guys that Ford, just like a couple of weeks ago, they stopped producing cars. Coming up, they're not going to produce cars anymore. Okay, so think about it. Ford, the first company that made cars, is not going to produce cars anymore. They're only going to be making trucks. Okay, now people say the economy is good. Okay, but some of these big giants like Toys R Us, and I mean, you can just go on and on and on. They're all going belly up. Okay, you have big corporations buying their own stocks to inflate the stock prices. Okay, and they say unemployment's down and all this stuff, but there's companies struggling, and there's governments struggling all over the world. And the funny thing is, it doesn't have to the meltdown doesn't have to happen in America. It can happen in Germany. It can happen because of Deutsche Bank. It can happen because Spain defaulted. It could happen because uh, Greece default, what have you, guys. And it could be just a domino effect. Okay, so what does that mean for me as a real estate investor? I'm not sweating it. Once this thing happens, it's going to be a fire sale in real estate. Assets are going to be below production costs. So listen to me, and listen to me good. I'm excited. When a meltdown happens, it's going to be a, what I call, a subject to heaven, owner financing heaven, because I'm going to be able to buy properties below production cost. So if to build a home costs 100K, I could buy this home right now from the bank through a short sale, or from a motivated seller, or at the auction for 80. Okay, below production cost. Okay, if I was going to make the same exact home with the same exact accessories, like the way the carpet is, looks the same, the paint is the same appliances, it would cost me 100, but I can buy it below. So it's going to be a great opportunity to buy properties or assets below production cost, just like gold. There's times that where you can buy gold below the cost of digging it out of the ground. Okay, that is a good time to buy it, because if it costs, let's say, manpower, trucks, gas, insurance, shovels, all this stuff, $1,000, and but gold, you can buy it at the spot price for 800. That's a hell of a good time to buy it, because you've already made money whenever you buy, guys. Okay, so simply put, this crash is coming. I've been reporting it. I've talked about it for almost 3 years now. I don't have a crystal ball. I don't say I do, but I can just watch around people. Everywhere you go, they're building apartment complexes. Everywhere you go, builders are building. Everywhere you go, lending is getting loose as goose, guys. Okay, they're lending out to people left and right. I brought it on my channel that uh, unstated income loans are bag, subprime lending is bag. Just it's just called a different name. Um, I brought it into my channel a couple of months ago, maybe even longer, that how they changed the debt to income ratio. So because so many people have student debt loans and they couldn't qualify for a mortgage, and if there's no mortgages being produced, the meltdown happens. So they changed it up so you and your friends or your family or whoever can get into more debt and buy an asset that's an inflated price. What do I mean by inflated price? If you just Google it, guys, property values like in some states, like for example, Colorado, has doubled in 10 years. So if a house was worth 200, now it's 400 in just 10 years, guys. Okay. Now there's many different factors because of EQ, us printing money. That's one factor, but things are just like going up. In some states, realtors are suggesting to their clients to pay over the asking price, guys, over the asking price, and they feel good about it. They post on Facebook, and I'm looking at it like, man, because I'm thinking that realtor just fucked up because they're supposed to get the best deal for their clients, and they're telling them, they should pay over. But it's none of my business. But man, that's not how I want to buy properties, guys. I want to buy it below production cost. So if it costs 100 to make this house, I want to buy it at 80. And there's two ways to buy it like this. You got to wait for a recession or a depression, which is coming very soon. And the other way is to buy from what's called motivated sellers. And motivated sellers are people just like you and me. They're good people that just fall off the horse because of life punches them in the face. Okay, that has happened to me, guys. Okay, and it doesn't mean I'm a bad person or may have happened to you or people you may know. Okay. So motivated sellers are people that have problems, and they could be two types of problems. It could be financial problems or they could be emotional problems. Okay. I like buying houses from people that have emotional problems because I can get good deals. I can have high equity. Now, financial problems, you can still get good deals, but I found the best deals with people that have emotional problems. One example is, you know, you, a seller calls you, they live in out of state and their dad has just died, okay? And they don't want to go back to that hometown, move all the stuff out of it's just too much headache. So they're just like, you know what, I'm just going to sell it all, okay? And I don't care whatever I get. The house is free and clear. It's a liability for me. I don't want to deal with it. I got kids. I got a new kid coming up. I got a full-time job. I'm getting paid good, etc. Okay? Or another situation is, a family member inherits the house and the parents pass away and they have all these back taxes on the property. Okay, it could be IRS, it could be other liens, and now those people that have inherited the house also inherit all the problems. Okay, and they don't want to deal with that because again they have a family, they work all the time, they don't have the extra money, whatever the situation is, and that causes motivation, guys. Okay, so two ways to buy properties from sellers motivated in the recession or depression, where you buy below production cost. And then two is if you deal with motivated sellers, and that's what I teach at mrnofluff.com, how to market to motivated sellers, how to find motivated sellers, how to filter motivated sellers, because not everyone's going to give you the house via owner financing. Not everyone's going to give you a house 60 cents on a dollar. But there are many that will, because just like the pawn shop, we're the pawn shop of real estate. At least that's what I do, and that's what I teach at Mr. No Fluff. Anyways, guys, before I get out of here, thanks for watching. I have much love for you guys, and remember, it's our anniversary sale. We're giving away all of our products for free, almost for free, guys. I would go check it out, mrnofluff.com. You're not gonna regret it. Check out the reviews. I've only been in business in this business. We turned into a business for 1 year. We've been doing these free videos for you since 2013, totally for free. Just been helping so many people out. They've been emailing me, texting me, doing videos for me. I really appreciate every one of you guys that reach out to me. You take my information and you make it happen for yourself. Even if you don't support me with your dollars, just by you letting me know that, I'm helping you, man, it makes me feel so much better, guys. I'm not gonna lie to you. It really makes me feel better that the path that I've come through, I could at least light up a couple of lamps, and help other people get where they want to go in life, guys. Hustle and bustle, don't take no for an answer. Check out MrNoFluff.com. We're giving you all the products for almost for free. See you later, gang.